In 2008, the world came close to a complete financial shutdown. Banks were hours away from missing payments. Money market funds were preparing to freeze withdrawals. ATMs were at risk of going empty within days. The trigger wasn't mortgages or housing alone. It was something far larger, hidden deeper inside the system. A $40 trillion web of derivatives that almost nobody outside Wall Street understood. Back then, regulators said the lesson was clear. The world needed less complexity, less leverage, and fewer opaque contracts tying every major financial institution together. But the reforms never matched the scale of the problem. Instead of shrinking, the derivatives market multiplied. Today, it exceeds $400 trillion in notional value, more than 6 times the size of the global economy. Derivatives were originally built to manage risk. A farmer could lock in the price of his harvest. An airline could stabilize fuel costs. A bank could hedge interest rate exposure. But over time, the purpose shifted. What began as insurance evolved into speculation. What started as a tool became an entire shadow ecosystem, where small miscalculations can trigger losses that spread instantly across borders. Most people don't see this market. They don't notice it in their daily lives. Yet it underpins mortgages, pensions, corporate borrowing, government financing, nearly everything. And because it is so large and interconnected, a failure in one corner can cascade through the entire network. The world survived the last crisis by spending trillions. In 2025, the cost of survival may exceed what any government can provide. The story of the $400 trillion debt bubble does not begin in 2008. It begins decades earlier, in the quiet corners of financial engineering, long before most people had ever heard the word derivative. In the 1,970 seconds, the global economy was becoming more unpredictable. The collapse of the Bretton Woods system ended fixed exchange rates. Oil shocks sent inflation surging. Interest rates swung violently. Businesses, banks, and governments suddenly needed a way to protect themselves against price movements they could no longer control. The early derivatives market emerged as a solution to that instability. It started with modest goals: allow companies to lock in prices, manage currency exposure, and stabilize borrowing costs. At first, it was simple. A futures contract on wheat, an interest rate swap between 2 banks, a currency hedge for an exporter. These tools helped reduce uncertainty at a time when global markets were becoming more interconnected and more volatile. But derivatives grew in importance for another reason. Traditional banking was changing. After the 1,970 seconds, financial regulation loosened. Banks could take on more risk. Globalization created massive new flows of money seeking higher returns. With more competition, institutions needed new ways to profit. And derivatives offered exactly that: a way to generate income without holding traditional assets, to create exposures without tying up large amounts of capital. The transformation accelerated in the 1,980 seconds. Wall Street innovation surged as computers became more powerful and financial mathematics became more sophisticated. What had been a niche tool slowly became a central feature of modern finance. Traders realized that derivatives could be created for almost anything: stock prices, interest rates, credit risk, inflation, even the probability of a company defaulting. Banks found they could take the same pool of risk and slice it, repackage it, sell it, and trade it again in different forms. The market's complexity deepened when policymakers embraced these instruments as signs of progress. To them, derivatives represented efficiency and modern risk management. They allowed markets to distribute risk, a phrase that would later prove dangerously misleading. Regulators assumed that if risk was spread widely enough, no single failure could threaten the system. In reality, spreading risk meant connecting every part of the system to every other part, often in ways few understood. As banks grew larger and more international, their derivative exposures grew with them. Large institutions built entire departments dedicated to structuring, pricing, and trading these contracts. Derivatives became a hidden backbone of the financial system, unseen by the public, yet essential to the functioning of interest rate markets, corporate lending, pension management, and government borrowing. By the 1,990 seconds, the real turning point arrived. Derivatives moved out of regulated exchanges and into private agreements between institutions, known as over-the-counter (OTC) contracts. These deals were customized, opaque, and often unreported. The lack of transparency meant banks could build massive exposures without the market knowing. The trading of these contracts created a new type of financial power. Banks with the biggest balance sheets could dominate the market. They had the resources to create, trade, and hedge complex exposures. Smaller institutions relied on them for pricing and liquidity. This concentration of influence made the system more fragile. The failure of a major player would disrupt the entire network. The late 1992 exposed the danger for the first time. Long-term capital management, a hedge fund run by some of the world's most respected financial thinkers, collapsed under the weight of its derivative bets. It had used enormous leverage to amplify tiny price differences across global markets. When its positions moved against it, the losses ballooned. The Federal Reserve intervened, organizing a private bailout to prevent wider contagion. The message should have been clear. Derivatives, when combined with leverage, could threaten the world's financial stability. But instead of tightening oversight, policymakers took the opposite approach. In 2000, the Commodity Futures Modernization Act explicitly prevented regulators from overseeing most derivatives, particularly credit derivatives like credit default swaps. The decision reflected the prevailing belief that markets could regulate themselves, that innovation should not be constrained, and that risk moved more efficiently when governments stepped aside. The stage was set for exponential growth. As the 2000s began, banks used derivatives to expand credit, obscure risk, and reduce capital requirements. They discovered they could turn risky loans into highly rated securities by pooling them and insuring them with credit derivatives. Institutions around the world bought these products believing they were safe, not realizing that many were built on fragile foundations. When the U4 housing market cracked, the entire structure collapsed. By 2008, the danger that had been invisible for decades suddenly became unmistakable. Derivatives amplified losses, transmitted shocks instantly across borders, and made it impossible for governments to predict where the next failure would occur. Yet even after the crisis, the underlying system remained intact. The reforms were partial. Capital requirements went up, but derivative volumes kept rising. Reporting improved, but private contracts remained dominant. Transparency increased slightly, but not enough to show how deeply intertwined the financial system still was. The origins of today's $400 trillion debt bubble lie in that historical arc, a progression from simple hedging tools to a vast, interconnected ecosystem of financial contracts that few fully understand. It developed gradually, shaped by decades of deregulation, innovation, competition, and the belief that risk could be engineered away. That belief, repeated often enough, became a foundation of global finance. The origins matter because they reveal a central truth. The system was not built with malicious intent. It was built through a series of choices and incentives that made sense in the moment. Yet those choices created a structure so large and complex that its stability depends on assumptions that may no longer hold. The rise of the modern derivative system did not happen through a single breakthrough or dramatic shift. It grew through accumulation, a slow expansion driven by competition, opportunity, and a global financial culture that rewarded innovation long before it questioned consequences. By the early 2000s, derivatives were no longer just tools. They had become the architecture of the world's financial engine. What accelerated their rise was the pursuit of yield. After the dot-com crash and the economic slowdown that followed, interest rates fell across the developed world. Investors faced a difficult environment. Government bonds paid very little, corporate credit markets were crowded, and equity markets remained volatile. Institutions responsible for pensions, insurance policies, derivatives offered exactly that blend of promise and illusion. Banks designed products that transformed risky assets into seemingly predictable streams of income. Mortgage-backed securities and collateralized debt obligations turned thousands of loans into structured layers of risk. On the surface, these products looked diversified and sophisticated. Underneath, their value depended on the assumption that housing prices would never fall nationwide. Few questioned that assumption, because the models said the risk was small and the credit ratings said the instruments were safe. Behind the scenes, derivatives multiplied. Every layer of a structured product could be hedged with a credit default swap, and every hedge could be hedged again. Banks kept building new instruments that allowed them to hold less capital while reporting higher profits. These innovations were not incidental. They became central to bank strategy. Derivatives allowed them to reshape their balance sheets, expand leverage, and generate fees without taking on assets in the traditional sense. The market grew globally as well. European banks adopted similar strategies, often relying even more heavily on leverage than their American counterparts. Asian financial centers developed their own versions, tailoring products to local markets. The result was a vast, interconnected web of exposures, linking institutions across continents. No major country stayed outside the system. The pursuit of efficiency, lower borrowing costs, higher returns, greater liquidity, created a shared dependency on complex financial instruments whose risks were rarely understood in full. The shift toward ultra-low interest rates after 2001 amplified the trend. Central banks around the world wanted to stimulate growth and prevent recession. Cheap money encouraged borrowing, and derivatives made borrowing easier to manage. Corporations locked in interest rates through swaps. Governments used them to stabilize debt costs. Investors used them to build leveraged bets on future market movements. Every part of the global economy began to rely on these tools, sometimes without realizing how central they had become. What made this rise especially powerful was the perception of safety. Financial models showed that risk could be measured precisely. Rating agencies assigned high grades to structures that were anything but stable. Regulators believed the system was resilient because risk was distributed. Banks believed they were protected because they hedged their exposures. Even when concerns surfaced about housing prices, leverage ratios, and opaque balance sheets, they were dismissed as unlikely scenarios. Derivatives also created new forms of interdependence. When Bank A hedged its exposure with Bank B, and Bank B hedged with Bank C, each institution became dependent on the solvency of the others. The system began to resemble an electrical grid. Efficient when everything worked, catastrophic when a single circuit failed. No one had a complete map of that grid. The connections were too numerous, too complex, and often too private to track. The rise of electronic trading and algorithmic pricing added another layer of speed and fragility. Markets could react in milliseconds. A small shock in one asset class could instantly influence others. The system was faster, larger, and more leveraged than anything in history. And yet the narrative inside the industry remained optimistic. The growth was framed as progress. Complexity was seen as sophistication. Derivatives were viewed not as risks, but as stabilizers. By 2007, the scale of the market had grown beyond the comprehension of most observers. Over-the-counter derivatives reached tens of trillions in notional value. Interest rate swaps alone formed the backbone of global finance. Banks depended on them to manage balance sheets. Corporations depended on them for borrowing predictability. Governments depended on them for debt stability. The world had become accustomed to a financial structure where derivatives were not optional, they were foundational. This was the rise that set everything in motion. A system expanding faster than oversight, deeper than transparency, and more interconnected than the models assumed. It was built on a belief in control, the belief that risk could be engineered, shaped, and neutralized through mathematics and contracts. For a time, that belief seemed justified. Markets grew, credit expanded, economies boomed, but stability built on assumptions is fragile. The system did not break all at once. It eroded slowly, shaped by incentives that encouraged risk-taking far beyond what the public ever saw. By the mid-2000s, the derivative market had drifted away from its original purpose. What had started as a tool to manage uncertainty had become a way to manufacture profit from leverage, opacity, and financial engineering. Inside major banks, the pressure to generate returns intensified. Shareholders demanded higher profits every quarter. Executives tied their compensation to short-term performance. Traders faced expectations to outperform not only rival firms but their colleagues across the trading desk. In that environment, derivatives became the perfect instrument. They allowed enormous exposure with limited upfront capital and the complexity made the risks difficult to measure. At times, institutions didn't just misunderstand their exposures, they barely tracked them. This growing opacity created internal conflicts. Risk managers, tasked with monitoring dangers, found themselves marginalized. Their warnings carried less weight than the models used by traders or the revenue numbers reported at the end of each quarter. When risk management did intervene, its authority was often limited by cultural and structural barriers. Risk officers could highlight vulnerabilities, but they rarely had the power to halt profitable activities, especially those that competitors were pursuing aggressively. The assumptions embedded in the financial models were another source of quiet corruption. These models relied on historical data that did not capture rare or extreme events. They assumed diversification reduced risk, even when assets were deeply correlated during crises. They treated housing markets, interest rates, and credit conditions as stable. These assumptions were not fraudulent, they were simply convenient. They created an environment where uncertainty was underestimated and leverage was allowed to build unchecked. As the system expanded, the reliance on counterparties grew more dangerous. A derivative contract was only as good as the institution on the other side. Yet many banks built exposures assuming their counterparts would always be solvent. They treated credit ratings as guarantees, even though the ratings often lagged behind real conditions. When a firm weakened, its counterparties faced not just market losses but the risk that promised payments might never arrive. That vulnerability created a chain reaction potential that few recognized. Credit derivatives, particularly credit default swaps, amplified these risks. They were initially designed to insure against loan defaults, but they quickly morphed into speculative tools. Institutions could buy insurance on assets they did not own, creating bets far larger than the underlying credit itself. This distorted pricing, rewarded speculation, and encouraged a level of leverage that few could track. The size of the market expanded faster than the ability of regulators or even participants to understand who held what risks. By 2008, conflicts were everywhere beneath the surface. Rating agencies assigned high grades to securities built from weak foundations. Regulators lacked both the information and the authority to oversee the shadow banking system. Market participants trusted models more than human judgment, and the models could not capture the fragility of interconnected leverage. When the US housing market began to crack, the weaknesses became impossible to ignore. Derivative exposures magnified losses. Institutions that believed they were hedged discovered their hedges were concentrated with a handful of counterparties who were themselves collapsing. Insurers like AIG had written protection on enormous quantities of credit derivatives without holding sufficient capital. When defaults surged, they could not cover their obligations. The failure of one institution threatened to pull others down with it. The corruption was not a conspiracy. It was systemic. Every part of the financial ecosystem had adapted to incentives that encouraged growth, complexity, and leverage. Banks built products that produced fees. Investors bought them to chase yield. Regulators assumed markets were self-correcting. Rating agencies relied on models that underestimated risk. Governments encouraged credit expansion to stimulate growth. Each decision made sense in isolation. Together, they created a system that was far more fragile than anyone wanted to believe. The aftermath of 2008 exposed these flaws, but it did not eliminate them. The reforms that followed focused on capital requirements, reporting standards, and stress tests. They were important steps, but they did not transform the underlying structure. Derivatives remained central to global finance. Over-the-counter contracts continued to dominate. Interconnected exposures persisted. And the world's reliance on low interest rates, a response to the crisis, set the stage for even greater leveraging in the decade that followed. The system emerged from the crisis with more oversight, but also with more debt. Governments absorbed losses through stimulus spending and bailouts. Corporations refinanced at ultra-low rates. Markets rallied. The same conditions that had allowed derivatives to grow rapidly in the early 2000s reappeared again after 2010, magnified by the scale of global intervention. In theory, the system had become safer. In reality, the risks had shifted, not reduced. The correlations were deeper, the exposures were larger, and the confidence that the system could be controlled had returned. This was the true conflict. the gap between how stable the system appeared and how unstable it actually was. The world believed that complexity had been tamed. But beneath the surface, the conditions that had fueled the last crisis were reforming only now at a scale no previous generation had ever encountered. By the early 2022s, the financial system had entered a new phase. The warning signs were visible, but they no longer shocked anyone. Global debt had climbed to levels once considered unthinkable. Corporations borrowed cheaply to buy back shares. Governments ran persistent deficits, assuming low interest rates would last indefinitely. Consumers relied on credit to manage rising living costs. The world had become comfortable with leverage, because leverage had not yet produced another 2008-style collapse. But comfort can be dangerous when it rests on fragile foundations. Beneath the surface, the derivatives market had ballooned to more than $600 trillion in notional value. Interest rate swaps alone accounted for a majority of that figure, linking governments, banks, pension funds, and corporations into one vast network. As long as interest rates stayed low and markets remained calm, these contracts functioned smoothly. But stability had created its own vulnerability. It encouraged assumptions that future conditions would resemble the recent past. The turning point came when inflation surged globally in the early 2020s. Central banks that had spent more than a decade stimulating growth were forced to shift in the opposite direction. Rates rose rapidly, and the speed of that rise exposed weaknesses that had accumulated quietly for years. Institutions holding long-dated assets saw their values fall sharply. Pension funds faced collateral calls on derivative positions they had used to hedge liabilities. Banks discovered that the cost of rolling over short-term funding had increased dramatically. As conditions tightened, the interconnectedness of the derivative system became more dangerous. One institution's loss could trigger margin calls, forcing asset sales that pushed markets downward, creating losses for others. The system that had appeared resilient under low-rate conditions showed how finely tuned it actually was. Small shocks spread quickly. The assumptions embedded in the models, correlations, liquidity, volatility, began to break down. Governments attempted to stabilize markets, but they faced constraints that did not exist in 2008. Public debt levels were already high. Fiscal space was limited. Central banks had less freedom to intervene because inflation remained elevated. The familiar tools lowering rates, injecting liquidity, were harder to deploy without worsening broader economic pressures. Policymakers found themselves navigating a crisis environment where both action and inaction carried risks. The problem was not a single failure. It was the cumulative effect of multiple pressures hitting simultaneously. A pension fund in one country struggled to meet collateral demands. A major bank faced losses on interest rate derivatives, tied to rapidly shifting yield curves. Emerging market governments experienced currency volatility that destabilized their debt burdens. Each event amplified the next, tightening funding conditions and eroding confidence. The crucial insight was that derivatives did not cause these stresses. They magnified them. They linked markets in ways that made it difficult to isolate problems. When interest rates moved sharply, the ripple effects traveled instantly across borders and asset classes. The exposures were so widespread that no institution, regardless of size, could fully understand how a shock in one corner might affect its counterparties. As tensions escalated, calls for intervention intensified. Markets expected governments to provide backstops, but the scale of potential losses dwarfed available resources. The notion of a multi-trillion-dollar bailout, once shocking, now looked insufficient. The world had built a financial system that depended on extraordinary stability. And when that stability cracked, the demands placed on public institutions exceeded their capacity. Eventually, policymakers were forced to adapt. Some interventions targeted liquidity rather than solvency, providing temporary relief to prevent immediate collapse. Others focused on restructuring exposures, encouraging institutions to unwind concentrated positions. These efforts slowed the pace of deterioration, but could not eliminate the underlying fragility. The system was too large, too interconnected, and too reliant on assumptions that had already failed. The transformation came not through decisive action, but through gradual recognition. Institutions began reducing leverage voluntarily. Regulators pushed for greater transparency. Markets demanded stronger collateral practices. Derivative books shrank not because of new rules, but because the old conditions that had allowed them to grow no longer existed. The era of cheap money had ended, and with it the justification for massive, opaque financial engineering. The collapse was not a single moment. It was a transition, a grinding adjustment as the world confronted the limitations of a financial structure built on leverage and complexity. What emerged was not a safer system, but a more cautious one, shaped by the realization that no institution, however sophisticated, could fully control or predict the behavior of a network as vast and interconnected as the global derivatives market. The aftermath of the Great Derivatives expansion is not defined by a single crisis, but by a shift in how the world understands risk, debt, and the limits of financial engineering. Once the immediate pressures of the early 2020s eased, institutions began reassessing the foundations of the system they had built over 4 decades. What emerged was a clearer understanding of just how dependent global finance had become on stability that could not be guaranteed. The most important legacy was the recognition that complexity does not eliminate uncertainty. It only obscures it. For years, the financial industry believed that sophisticated models could identify and price risk precisely. Derivatives were seen as mechanisms that allowed institutions to transfer or hedge risk efficiently. But the events of the past decade showed that risk cannot be removed from the system, it can only be shifted. When shocks hit, they reveal where those risks have accumulated, often in places that were overlooked or misunderstood. This realization led to a broader re-evaluation of leverage. For decades, low interest rates encouraged borrowing at every level. Households, corporations, and governments expanded their obligations because the cost seemed manageable. Derivatives amplified this behavior by creating the appearance of stability. Now the world understood that leverage does not just increase potential returns, it increases vulnerability. When conditions change, leverage accelerates losses and reduces the time available to respond. Another legacy was the return of transparency as a central priority. Before the crisis period, large portions of the derivatives market operated in near invisibility. Over-the-counter contracts, private bilateral deals, and complex exposures were hidden behind balance sheets that few could decipher. After the crisis, institutions began dismantling some of that opacity. More contracts were moved to clearinghouses, disclosures improved, and regulators demanded clearer reporting. These changes did not eliminate risk, but they reduced the blind spots that had allowed vulnerabilities to grow unnoticed. Perhaps the most enduring shift occurred in public perception. People who had never heard of derivatives in 2007 now understood that these instruments, though technical and distant, shaped the stability of their daily lives. Pension funds, mortgage rates, government budgets, all were tied to a market far larger than the world's economic output. As governments struggled to manage the consequences, confidence in financial institutions eroded. The public began questioning whether a system built on such scale and complexity could ever be made fully safe. This skepticism drove conversations about reform. Some argued for breaking up large institutions. Others pushed for stricter limits on leverage or a restructuring of the derivatives market itself. While no single solution emerged, the pressure reshaped policymaking. Regulators focused more on system-wide risks rather than isolated institutions. Stress tests incorporated extreme scenarios that once sounded improbable. The goal shifted from preventing all failures to reducing the chance that any single failure could threaten the entire system. In the corporate world, strategy changed as well. Firms that once relied heavily on derivative exposures began reducing them voluntarily. They questioned whether the short-term benefits were worth the long-term vulnerabilities. Pension funds reassessed hedging strategies. Insurance companies reconsidered the risks embedded in their portfolios. A quiet repositioning took place across industries, driven not by regulation but by experience. The transformation was not dramatic. There was no moment when the world declared an end to the debt-driven era of financial engineering. Instead, the shift unfolded slowly, as markets, institutions, and governments adjusted to realities that had long been ignored. The global system did not collapse entirely, but it did confront its limits, and those limits reshaped how policymakers, investors, and ordinary citizens thought about the future. In the end, The legacy of the $400 trillion debt bubble is a recognition of fragility. For decades, the world assumed that financial innovation could outpace risk, that markets could adapt faster than instability could spread, and that complexity was a sign of progress. The events leading into 2025 showed that progress without caution is simply accumulation, and accumulation can become a threat when it grows unchecked. The lesson is not to reject innovation, but to understand its consequences. Finance is most dangerous when it convinces people that uncertainty has disappeared. The world now knows that uncertainty never disappears. It only hides, and the longer it hides, the more powerful it becomes when it returns. Thank you for watching this video. Click here to watch another video that might interest you.